Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full-service firm headquartered right here in Boulder, Colorado. I want to start off with a quick story. A surgeon friend of mine and I were talking. I said to him, gosh, you've got your hands in that person's body and there's blood, and what if something bad happens? How do you remain calm? He's like, Mike, I've done this so many times. I know that along the way, it never goes exactly the way I thought it was going to, but I've done all my preparation. I've set my expectations, and I also keep my eye on how great this patient is going to feel when I've solved their problem with this particular surgery. I said, well, okay, that's great, but couldn't the person die? I mean, couldn't something really bad happen? He's like, Mike, yes, it would be improper for me to say that that's not a possibility. He goes, but it's pretty improbable. He goes, the problem is if we only focus on the absolute worst that could happen, then the benefit of that surgery, which is without question in the highest probability for that client, they're going to miss out on that. And sometimes not doing anything, it really hurts that particular patient. So yeah, it's a possibility. It might be improbable, but it's a possibility. But if so, I can handle it as well. He goes, so I set myself up for success. In his particular case, he doesn't do super at-risk surgeries. That's for someone else. And of course, the probability of the really bad things happening increase. But he does non-high-risk surgeries, and so it's not something that he worries about on a daily basis. The reason why I bring that up is because one of the values that I hope to bring with clients and to you, the viewer of this, if you're not one of my clients, is some experience, some perspective, some long-term vision. What's the big picture on this? I've been doing this for 24 years, and so I did a little bit of math before jumping on this video, and assuming there's about 200 trading days, 200 times 24, that's give or take a little bit less than 5,000 trading days, 5,000 data points that I've seen in my career. And so when the market is up 2 or 3% or it's down 2 or 3%, I don't sweat it one way or the other, because like a mosaic picture, I've got to take it and look at the big picture and see where does this all form. I'm going to put up on a chart there. This is the Dow Jones Industrial Average, which is an unmanaged stock market index for the year. You will notice that if you were able to invest in this particular index, and I just circled in red, you're negative. That stinks for that particular point. From that point to where we are today, it's negative. You're like, oh gosh, that's so disappointing. Maybe I'm going to lose more money. This isn't what I had hoped for. Well, let's take the exact same chart and put it over 3 years. This is the trailing 3 years back, and you're going to see that there were some times when it was negative. Okay, but you know what? That's part of the journey. Okay, you've got to keep our eye on the big picture and the destination. And frankly, if your time horizon is 1 year, 18 months, maybe 2 years, I don't believe you should have your money in any kind of a equity position or a stock market. That's just my opinion. Let's go a little bit further out. Actually, what I'm going to do is I'm going to throw a bar chart up on the screen, because I really kind of like it. I've not shown this to you before. I just found it from an Ibbotson Associates, and I think it's kind of neat. Going back 89 years, okay? And I know that our time horizon is not 89 years, but I'm just trying to provide a big picture here. A lot of times when I'm talking with people that say, oh my gosh, I could lose all kinds of money, it's the catastrophic loss that is embedded in people's minds. And so the first piece of advice I have is set yourself up for success. Don't put it all into one stock, or maybe just a couple of stocks, or put it all into one particular sector. So if we have a diversified portfolio, which is what this bar chart is, I think that you increase your odds of having a better outcome. So in the 89 years here, what you're going to see is here, I'm just going to kind of quickly look at my chart. 73% of the time it's green. That's on the right-hand side. So just to make the math easy, 3 out of 4 times, the year was positive. Okay? 3 out of 4 times, the years were positive. If we add in that first bar chart there, which is the year ended between 0 and negative 10%, all of a sudden we've got 87% of the years in the last 89 years were slightly negative to positive. Okay. Now, if we look at that 1 year out of 89 that it was between 40 and 60% loss, that's a little over 1%. 1 out of 100. Okay. 1 out of 89 in this particular case. So if we look at between 20% loss or greater for the year, that does happen almost 7% of the time looking back 89 years. So it is not improbable. It is very rare. Okay. And so I think that we need to keep that in mind because we're not nowhere close to that. Here we are 3/4 into the year and it's not even close at this particular point. I'm going to put another chart up on here, and I have shown this before because I love it. Okay. Most people should have some kind of a mix between stocks and bonds, and you mix them together. Maybe in this particular graph, you have the green chart, the green bar is 100% stock market, S&P 500, unmanaged stock market index. The next one, the middle bar in there, is 100% bond index. And then the third one is a mix between the two, 50-50, okay? And then you've got them in, you've got these sets of the bars, and the first one is a 1 year time frame. So you've got high highs, low lows. The second one is 5 years. The third grouping is 10 years, and the fourth grouping is 20. And one thing that we will see is going back 64 years. This is to 1950, going 64 years. There's never been a 5-year time frame where a 50-50 of stocks and bonds has lost money. You've made at least 2% a year. So maybe you lost money, and then the fourth and fifth year bailed you out. Okay. And in the future, it absolutely could be different. Okay. You don't know what the future is, and I don't know what the future is. Okay. And anyone who says that they do know is lying to you. Okay. And don't listen to them and run the other way. I'm here to be honest and upfront with you and keep you focused on, you know what? The journey sometimes is a little messy. Okay. But the destination is worth it. And our time horizons should be 2, 3, 4, 5 years or greater. And so even if you've just retired, you hopefully have a time horizon of 20 or 30 years. Okay, at 65, the probability of you, and if you're married, of living to 90 years old is actually quite high. Okay, and so we've got a long time horizon there, and so that's what we've got to keep the big picture. Now, so to answer, one more graph that I want to put up there, and I've shown this to you as well. The red numbers are the intra-year decline. So the declines throughout the year where, went to a high and then it went down, and then where the year ended. It is normal for there to be, within the year, declines of double digits, 10% or more. As a matter of fact, over the last 2-3 years, we've been dulled into having remarkably low on the downside. So when it does happen, like this year, we get all up in arms. And we've got to remember that that's the abnormal, all right? It usually is a bigger decline throughout the year, and every year is not positive. However, most of them are. Okay, 3 out of 4 going back 89 years historically have. And if we look back here, going back to the 50 years, 27 out of 35 have been positive. Okay, so we've got to remember that going forward. Am I worried? Not at all. Okay. I feel that I'm the surgeon, hopefully right in the middle of that surgery. Never goes exactly the way you want, but I've got, in my opinion, great investments for myself and for my clients. I meet with clients along the way to make sure that they're appropriate for the client and to ensure that our behavior is such that we don't do rash things. I mean, one of the conclusions that I've come to over my career is that what really hurts us is our behavior and our attitude, but that also can help us, staying calm, etc. So I'm not worried whatsoever. I'm not going to lie to you. This is the journey. The journey is not always pretty, but I've got my eyes set on the outcome. My ship is, my analogy of the journey, my ship is solid. I'm feeling good about the managers that I have and the portfolios that I have for myself, and I'm always reviewing those with clients. I feel confident as well. So anyway, 303-747-6455. Mike Brady, love to hear from you. My email, mike@generositywealth.com. I'm here to help as we go through this journey together. Have a great day. See you. Bye-bye.